Is now the time to buy gold? An investor's guide. Gold has long been considered a safe haven for investors, particularly during periods of economic uncertainty, inflation, or geopolitical tension. If you're considering whether now is the right time to add gold to your portfolio, here's an in-depth guide to help you make an informed decision. Why investors turn to gold? Inflation hedge. Gold often retains its value during inflationary periods. When currencies lose purchasing power, gold prices typically rise, making it an attractive option to preserve wealth. Safe haven asset. During economic downturns, financial crises, or geopolitical turmoil, gold's stability makes it a popular choice to offset risks in equity markets. Portfolio diversification. Gold has a low correlation with stocks and bonds, making it a useful tool to diversify and reduce overall portfolio volatility. Current market conditions. Before deciding to buy gold, consider these factors. 1. Economic uncertainty. Are interest rates rising or falling? Is the global economy in turmoil? Rising interest rates can reduce gold's appeal as it doesn't yield dividends or interest, but economic uncertainty generally supports its demand. 2. Inflation trends. Are inflation rates accelerating? Are central banks continuing monetary tightening or easing? Persistent inflation boosts gold's appeal, especially if fiat currencies weaken. Current market conditions. 3. Geopolitical events. Global conflicts, trade disputes, or political instability often drive investors toward gold, elevating its price. 4. Dollar strength. Gold prices often move inversely to the US dollar. A weaker dollar makes gold more attractive to international buyers, driving up prices. Gold investment options. If you've decided to invest, you have several ways to gain exposure to gold. 1. Physical gold. Coins and bullion. Tangible assets you can hold, but they involve storage and insurance costs. Jewelry. Often less cost-effective due to higher markups. 2. Gold ETFs and mutual funds. Provide exposure to gold prices without owning physical assets. Offer liquidity and lower transaction costs compared to physical gold. Gold investment options. 3. Gold mining stocks. Investing in companies that mine gold can offer leveraged exposure to gold prices but comes with business-specific risks. 4. Gold futures and options. Suitable for advanced investors comfortable with leverage and higher risks. Potential risks of investing in gold. Volatility. Despite its reputation, gold prices can experience significant short-term fluctuations. Opportunity cost. Gold does not generate income like stocks or bonds. Market timing. Timing the gold market can be challenging, as prices are influenced by many unpredictable factors. Is now the right time to buy? To determine if now is the time to invest in gold, ask yourself. 1. Do you need a hedge against inflation or economic uncertainty? 2. Is your portfolio well diversified, and can it benefit from adding gold? 3. Are current market conditions favorable for gold investment? Tips for buying gold wisely. 1. Start small. Allocate a small percentage, 5 to 10%, of your portfolio to gold, depending on your risk tolerance and financial goals. 2. Research the market. Understand current gold price trends and underlying factors driving them. 3. Avoid emotional decisions. Don't buy gold out of fear or speculation. Focus on long-term investment goals. 4. Monitor regularly. Keep an eye on economic indicators, central bank policies, and geopolitical events that may impact gold prices. Summary. Gold can be a valuable addition to an investment portfolio, particularly during uncertain times. However, whether now is the right time to buy depends on your financial situation, market outlook, and investment goals. Consider consulting a financial advisor to determine the best strategy for incorporating gold into your portfolio. Why add gold to your portfolio? Adding gold to your investment portfolio can offer several benefits, particularly in terms of diversification, protection against risks, and long-term value retention. Including gold in your portfolio doesn't guarantee higher returns but helps balance risk and provides a stable store of value, making it a valuable addition to most investment strategies. Here are some reasons to consider. Why add gold? 1. Hedge against inflation. Gold has historically retained its value over time, making it a reliable hedge against inflation. As the purchasing power of fiat currencies decreases due to inflation, gold prices often rise, preserving wealth. 2. Portfolio diversification. Gold typically has a low correlation with other asset classes, such as stocks and bonds. Adding gold to your portfolio can reduce overall risk and volatility, particularly during economic downturns. Why add gold? 3. Safe haven during economic uncertainty. In times of geopolitical tension, economic crises, or market downturns, gold is often seen as a safe haven asset. Investors flock to gold to protect their wealth, which can drive up its price during uncertain periods. 4. Intrinsic value. Unlike paper currencies, gold has intrinsic value due to its scarcity and its wide use in industries such as jewelry, electronics, and medicine. This intrinsic value provides stability over time. Why add gold? 5. Liquidity. Gold is highly liquid and can be easily converted into cash almost anywhere in the world. This liquidity makes it a valuable asset in emergency situations or when quick access to funds is needed. 6. Currency diversification. Gold can act as a form of currency diversification, particularly for investors concerned about the stability of their home currency. Its value is globally recognized and not tied to any specific country. Why add gold? 7. Potential for long-term growth. Over the long term, gold has shown a tendency to appreciate in value, especially during periods of declining trust in financial systems or economic instability. 8. Limited supply. Gold's supply is finite, and mining becomes more challenging and costly over time. This limited supply can help support its value, especially in the face of rising demand. Why add gold? 9. Protection against currency devaluation. When central banks print money excessively, it can lead to currency devaluation. Gold serves as a store of value that is not subject to the same risks. 10. Global demand. Gold is in constant demand across the globe for various purposes, including investment, jewelry, and industrial uses, ensuring a consistent market. How to invest in gold. Physical gold. Bars, coins, or jewelry. Gold ETFs. Exchange-traded funds that track gold prices. Gold mining stocks. Shares in companies that produce gold. Gold futures and options. Contracts to buy or sell gold at a predetermined price. Digital gold. Platforms that allow small-scale gold investments. Who should add gold to their portfolio? Adding gold to a portfolio can be a strategic decision based on an individual's financial goals, risk tolerance, and market outlook. Here are some categories of investors who might benefit from including gold in their investment strategy. Who should add gold? 1. Investors seeking diversification. Gold often behaves differently from stocks, bonds, and real estate. It has a low or negative correlation with other asset classes, helping reduce overall portfolio risk. 2. Those concerned about inflation. Gold is traditionally considered a hedge against inflation. When currency values decline, gold's value tends to hold steady or increase, preserving purchasing power. Who should add gold? 3. Investors preparing for economic uncertainty. During financial crises, geopolitical tensions, or market downturns, gold is often viewed as a safe haven asset. It tends to retain value better than other assets in volatile markets. 4. Long-term wealth preservers. Gold has been a store of value for centuries and can provide long-term stability. It is a tangible asset that isn't directly tied to the performance of a specific economy or company. Who should add gold? 5. Retirees or near retirees. These individuals often seek to preserve wealth and minimize risk. Gold can be a stabilizing force in their portfolios. 6. High net worth individuals. They may add gold as part of an overall strategy to protect wealth and hedge against systemic risks. Gold can act as insurance for large portfolios. Who should add gold? 7. Speculative traders. Those who anticipate short-term price movements in gold might include it to capitalize on fluctuations. This strategy requires active monitoring of gold prices and market trends. 8. Global investors. Investors in countries with unstable currencies or economies may favor gold as a safer alternative to local assets. For example, individuals in emerging markets or regions with political instability. Considerations before adding gold. Proportion. Experts often recommend 5 to 10% of a portfolio in gold. Form. Decide between physical gold, coins, bars, gold ETFs, mining stocks, or mutual funds. Costs. Physical gold incurs storage and insurance costs, while ETFs and stocks might have management fees. Liquidity needs. Gold is relatively liquid but might not provide income like dividends or interest. Subscribe, like, hit that notification bell for more information. If you enjoyed this video, give it a thumbs up, and share it with your money friends and associates. Don't forget to subscribe, like, hit that notification bell for more information on money every day, week, month, and year. Let me know in the comments your thoughts on the current information. Thank you for watching.